Welcome everyone to webinar 2 of the Oliver Kell Swing Trading Masterclass. Super excited to have you all here, and this is going to be a really excellent presentation from Oliver. Talking about what we'll be covering today in webinar 2. Oliver, if you go to the next slide. This is focused on finding true market leaders, how Oliver basically identifies opportunities, organizes his watch list, his scans, and also his daily and weekly routines. And going through the agenda of today, we'll be starting off with some overviews. Oliver, if you go to the next slide, please. First, we'll be talking about the scans overview, going through the tools that Oliver uses, going through each individual scan, the list, the weekend routine, daily routine, and finally a live walkthrough of how he uses FinViz, MarketSmith, and also TOS to organize and prepare for the next day. And then obviously at the end, we'll have a dedicated Q&A section, and we'll also be answering questions live throughout the session as it's relevant. So please, during the presentation, let us know your questions down below in the Q&A section. That kind of helps keep everything organized, and we'll try to get as many questions answered as possible. And also, this is recorded, as you can see down here on the screen, and it'll be archived for you to watch as many times as you want. So with that said, once again, super excited to have you all here, and I'd like to introduce the U.S. Investing Champion of 2020, Oliver Kell. And Oliver, I'll hand it over to you.
Okay, thanks, Richard. Hey, welcome back, guys. Glad we're kind of hopping into session 2. And another thing, we're going to go through UPST at the end as well. I know that's something that people definitely want to review, so we'll look at that. And so one of the questions that I always get is, how do I scan? How do I find names, etc. So kind of before I hop into all the different scans, lists, etc. that I do use, I want to emphasize that I really do just look through charts, and I often do trade a lot of the same names over and over again. Usually a name that I, trade well and have a winner on and maybe step aside on, that name will oftentimes set up again, maybe 2 to 8 weeks later or something like that. So I am often trading the same names over and over again. Now, there's certainly exceptions to that for sure, and things go through cycles and you have to find new names, and that's where the scans and the lists and things like that come into play. So let's hop right to it. So I'm going to start with the scans that I run. I'm going to kind of give a brief overview, quick run through of each, and then we're going to go into each, and I'm going to break down exactly how I do it. So key thing here, I think you talk to anybody who's been trading for a long time and has had success, they likely have some sort of routine as to how they go about their day, and it almost just becomes second nature. So it's going to seem like there's a lot of stuff on here, but I'm doing this all I'm not even thinking about it. I'm kind of doing it throughout the day or quickly after the close. And as you do it more and more, you just get faster and faster at it because you kind of get an eye for what you're looking for. And, you got to love the routine. It's very, very key. So first things first is just my bull snort scan. In a nutshell, this is just, we're looking for enormous volume. So I hear people say all the time that volume doesn't matter, blah, blah, blah. I totally disagree with that. I think volume's the key. And if I can find a situation where there's enormous volume, oftentimes there's a potential trade there over the next couple of days or weeks. So volume equals price, cause equals effect. If you can find big volume, it can often be the cause for that effective future price advance. Next would be gappers. So I love stocks that have huge gap ups that remain unfilled. So most people think gaps fill, and the little gap ups, gap downs, maybe 0.5% or 1% on no news or something day to day, they often do fill. But big gap ups equals the streets caught off guard. This is a key thing for me. And if you just think about that statement there, if you get a huge gap that remains unfilled, it can often be a breakaway gap, which can lead to a big advance. And the reason they remain unfilled is often there's some sort of news that the market wasn't expecting, right? So let's say a massive earnings surprise, a big upside beat, and maybe some of the big institutions are under positioned in that name because they just didn't expect the number to be that good. Or if you trade biotechs, maybe an FDA approval or something like that. Really, it could be anything. Maybe it's a pre-announcement that, again, the street wasn't expecting, and it's way higher than anything people had modeled. And now all of a sudden people are scrambling to get their shares, and it keeps the gap unfilled and then leads to that advance. So those are two of the main things that I look at. And oftentimes a big gapper will be a bull snort. So those are two. Then strength. This is something I'm really doing on down days in the market. I just have a relative strength scan where I'm looking for names that are green. I'm also just doing this by scrolling through my lists, kind of seeing what names are holding up the best. That's really the way that I look for strength. But this is a great little scan because if you get, if you fall into a correction where maybe you're green, 10, 12 of 15 days, and 9 of those days or 8 of those days, you're finding a name that's bucking the trend, that's certainly going to be something that you're going to want to pay attention to. And especially in corrections, this is important because that's when you really find new names that maybe you haven't traded before. Then a doublers scan. So this is stocks that double. It's really that simple. One thing I learned early on, specifically from Dan Zanger, is that stocks that double tend to be the ones that double again, which is, contrary to popular belief. I really learned this. There was this biotech stock. I can't even remember what year, but I remember the ticker PCYC started at like $12 or $20 or something. I can't even remember. And it just kept doubling. And people kept saying it can't go higher, it can't go higher. And then I think it got bought out at like $250 a share or something like that. And that, to me, when I saw that happen, I was like, okay, stocks that double tend to be the ones that double again. And I think that's very true. So then 52-week highs, it's really that simple. I'm not reinventing the wheel here. I try to track stocks that are making new highs. In this case, it's really one, you can find winners there because every big winner is going to make a 52-week high at some point. And then from that point on, they're just going to keep making them. But also you get a sense for what sectors are in favor. So if you start seeing, more recently, I know a lot of people have probably noticed the financials and oils making highs. It just gives you a sense, that's kind of where money's moving. If we're seeing sector rotation, those are the sectors that are kind of getting capital. So you can track it, one, to find new ideas. I mostly trade a lot of tech growth type stocks, so I might not touch those oils and financials, but I still want to know that's where the money's moving. So that I can just understand how aggressive to be with the things that I am trading. So I think it's important to track that 52-week highs list. And then percent gainers. I'll just kind of pull this up on Thinkorswim during the day and sort it by high price. And, if the stock's up 30%, I want to see it because oftentimes that ends up being a bull snort or a gapper or something. There's usually something unique going on there, and I want to pay attention to it. So the tools that I use to run my scans, finviz.com. I'm going to kind of run through this, but you can create a free account and save your scans. I've been using this for 10 years or so. I think it's super basic, super easy. There is a premium version that people use. I've never used it. I'm sure there's some good added benefits to it. I think some people use it, so maybe check it out. But for me and what I need, the free account works great. Then MarketSmith, it's definitely, from what I can tell, for people trading growth stocks, the top tool out there. It's about $100 a month. Full disclosure, I've never used it until this year. So I'm trying to learn the product a little bit better myself. I'll show you the main way that I use it when we kind of go through the run through. But there's certainly some great scans on there and things you can utilize to help you build a watch list, which, I'm trying to learn that myself. And then your trading software. So each trading software has scanning capabilities. I use Thinkorswim. I know a lot of people use TC2000. I think it's got some pretty great scanning abilities. So I can't talk too in depth there because your software is kind of specific to you. But I'll show you some of the ways that I use Thinkorswim. So kind of how do I set up these scans? So the bull snort, I've just taken a screenshot here of FinViz. This is my actual bull snort scanner, and it's not that complicated. I scan for stocks over 20 bucks with an average daily volume over 500,000 and a relative volume over 3. So basically is what I'm doing here. I don't really like trading cheap stocks. I could probably lower this to 15. But kind of the way that I view it is, you know, if a big winning stock is really going to work out, it's going to hit 20 bucks eventually, and it'll pop up on my scan eventually. Average volume, I do generally like trading stocks that trade well over 500K a share or per day, often over 1 million. But I don't want to choke anything off. So I just want to see the names that are up on volume. And then I can kind of use my discretion as to which ones I'm actually going to trade. And then relative volume. So I can't say I know exactly how FinViz looks at the relative part of it. But basically it's 3 times what the average daily volume is. So let's say you're looking at, you know, the 50-day average volume, the 20-day average volume, whatever it is, you're just looking for 3x, whatever that number is. And it's really just a sign, hey, this thing is printing, you know, a significant amount of volume. And often the best ones will be, you know, like 8 to 10 times the average daily volume. So I'm not looking for the stock that, you know, maybe trades 1 million shares a day and today it trades like 1.2 million, you know, like a good volume day. You know, I'm looking for that real outlier, like the 3 million when it normally trades 1 million, or the 15 million if it normally trades 5 million. And hopefully, you know, the 30 million if it mostly trades 5 million. So this is a real simple scan, and it gives you a list of names, and I'll kind of show you how I just kind of scroll through it and find, you know, pull out the ones that I want. So one of the, you know, I'm not a pure CanSlim trader, and I find some of the quickest, fastest moves you can get are actually, you know, a name that pops up on a bull snort and makes like a very quick, you know, 30 to 100% advance in like 3 to 5 weeks, or, you know, sometimes even quicker than that, 2 to 5 weeks. So I put a couple examples here of some trades that I took earlier in the year. So Triple D, this was a stock or this sector. I think I traded a lot back in like 2013 or something, so I was familiar with it. And there were some other unique things happening on these charts. You know, they really shook out the lows on the monthly and whatnot. But as what happened here is Triple D pre-announced, I believe it was a pre-announcement, you know, right here, and you can see this just enormous volume, just absolutely enormous volume. Look at it to the left. I mean, there's nothing even remotely close to this. And if you were watching this, sure, you could have bought this breakout for sure. But almost the power of the bull snort is, you know, I'm not scanning and looking for names off the lows in my day-to-day routine. But if I see this enormous bull snort, you know, now I have an opportunity to wait for an area to kind of hop on. So SSYS is a stock in the same sector that fundamentally I actually like better. And, you know, there are some reasons for that, but you can see that this also is up on volume, mainly on the Triple D announcement. And then is what I do is I wait and I look for an area to kind of hop on for the ride. So I actually found SSYS in this particular instance to be easier to get involved in because it kind of had this little flag. You know, you can see the next day it does get volume, but then the volume really dries up here and you get 3 light volume days, an inside bar here. And when we take out this high, you can get long, and then you can see that this literally rallies about 60%, you know, in 3 to 4 weeks. And when it loses the moving averages or this channel, or maybe you're taking some into strength, depending on your style, you know, you're getting out of the trade. And same thing with Triple D here. it basically had this, it not an inside bar, it failed down here, but this was an area to get long, or I think I've had a little here, but I found it harder and I added to it, up in this range. And then you can see, this thing really rallied almost 100% in a very small amount of time. So this thing even really almost doubled right here, and then it almost doubled again. So it just goes to show you huge upside advance, massive volume, and then you get that float higher. Now with these types of plays, you do definitely need to have sell rules, because these ones off the lows often roll right back over, but they can be quick hitters. And then ideally, if you don't really like playing these things off the lows, bull snorts happen all the time. Post earnings per share breakout is a bull snort if it's big volume, near the highs. Those are ideal situations where maybe you catch something that rallies for months. So that's the bull snort scan. And Richard, are there any questions on that?
Yeah, there's a good question here from Jay. Would Oliver consider adding a filter above a moving average, like stocks above the 50 SMA or 200 SMA? Why and why not?
So yeah, I think you can definitely do that. So if you were to filter for above the 50 or 200 SMA, the nice thing is that you're likely going to get more stocks that are above the 15-200 SMA, which is a good filter. And the reason maybe not to do that is you might miss some of these opportunities off the lows. The reason why I do like that, though, is even these are off the lows, but they're above the 15-200 SMA because they've had multiple months, if not years, to kind of build out a bottom. So I think it's totally valid. The only reason I don't do it is because I just like to see all the names that pop up on the bull snort, and then I'll use my own discretion. Like I am likely trading something that's above the 15-200 SMA, but I'll just kind of scroll through it and filter that with my eyes. But I think it's totally valid. If you find you're getting too many names on your bull snort, maybe you add a simple filter like that to narrow the list a little.
Absolutely. And does the catalyst that causes the bull snort matter to you, like whether it was earnings or news, something like that?
So yes and no. Inevitably, I do end up seeing kind of why a stock really ripped. But I wouldn't need to know the news to trade it. I actually think I often trade better when I don't know why something's happening, because then I don't have any bias. So yes and no, that's a tough one to answer, because I don't think you need to know why. But let's say it's like a true young growth stock that's in a stage 1 base, and it breaks out on some sort of news about an upside surprise to earnings or a new product that sold way more than is expected, or something like that. That might be really good to know and can kind of give you more conviction in holding that stock through pullbacks. So I would say it's more up to you and what you're comfortable with. I don't think you need to know the news, though.
Gotcha. And just to clarify for everybody, in today's webinar, we're focusing on scanning, list organization, routines. We're not super focused on the actual setups that Oliver uses to trade it. That's more covered in webinar number 3. But to ask one question, Oliver, how often, how do you enter a stock after a bull snort has occurred? And would you enter on the first day if you notice it early on in the day?
So I would enter on the first day if I notice it early on in the day. I often don't, because I more scan for bull snorts after the close.
Right.
Now, the thing is, during earnings season, there are situations where I'm entering a bull snort on a gap up because I'm literally watching the stock. And it's almost like I'm looking at the post-market volume when that company reports. I already know the weekly has a big base or something like that. I generally don't want to buy a gap up on something if there's not a base, behind it. And I'll play it, and then it's almost the volume and everything is confirmed, the next day when the buyers come in and fall through higher. So it's usually on earnings when I'm doing that. Otherwise, I'm finding them just on my scans. Then as far as how I enter them, I literally get the bull snort and I just, in both of these instances, I'll focus on this one because I think it was a smoother trade. I'll just kind of let it trade for a couple of days until I can feel like it's going to be easier. And you know what? Sometimes they just kind of keep going and I don't chase them in that instance because I'm just not comfortable doing that. Um, I also find if they keep going, they will eventually build a consolidation. And the ones that kind of keep going can then sometimes build the most, the best consolidations. So I don't chase them. I wait for that consolidation. In this instance, we get a little bull flag. And the key is here is the volume that dries up. Specifically, this is an inside bar, which is something that I'm going to talk about on the buying session. And you can see the volume is super dried up. This is something that I really, really, really look for when I'm looking for a new opportunity is that dry up inside bar day. Because oftentimes if you can take that out, it can lead to a move. And sure enough, you can see the volume comes in as we take it out. And, that's just kind of confirmation. So little things like this is often what I'm looking for. Or maybe, it's something that's longer. Like I often find on the earnings gap ups is what'll happen is you'll have an earnings gap up with a pivot. And if it's really, really, really powerful, it'll take out the high of that pivot and just run the next day. Or I find that they will base longer and actually base out until the 20 EMA catches up. Sometimes the 10 EMA, but I think it's actually a better pattern when the 20 EMA catches up. And then it'll have like more of a base and you can buy the break out of that base. So it's the most powerful ones. It's kind of the next day pivot high. Well, the most powerful ones are the ones you're watching where you buy the gap up, right? Or they're not necessarily the most powerful, but that's kind of entry potential one. Then 2 is the next pivot day high. 3 would be, base out into the 10 or 20 EMA. And those are more specific for earnings situations. But, maybe for a catalyst type situation like this, you're just looking for some sort of consolidation. And if you see huge, huge, huge volume on something like this that's not earnings, it's more of a pre-announcement or something, I find it's more of a surprise than like earnings. Everybody kind of expects earnings to come. Sometimes they come in good, sometimes they come in bad. And when they come in good, people want a position. But when there's something that's totally a surprise, like nobody was expecting this pre-announcement out of Triple D, then I find they actually don't wait too long. Like if you can see in these instances, they didn't even wait for the 10-day. So you really have to analyze that volume and the price action. And that's going to allow you to find an area to get on.
And do you consider what's happening to the left of the chart, or you only kind of care what's happening after the bull snort, that the huge volume coming into the stock?
So one of the big things that I think is real important when you're analyzing charts is to look for that kind of change of character. Mm-hmm. So in these instances, the bull snort is literally the change of character. So to say that I'm not looking to the left wouldn't be entirely true, because if you were to go back and look at Triple D and SSYS, they actually kind of stopped moving higher right around a resistance level on the weekly. If you were to go look left on these. So, it's important to know that, you're coming into resistance, you're a little extended from the 10-day, maybe you take a little bit off. But I am really trying to actually trade these from that change of character day. And then naturally, if you're playing a situation where things are at new highs, it's ideal because there's nothing to the left. There's no resistance. I mean, those are the, ideal situations. Sometimes the ones that come off the lows can be more, short squeeze type plays, which is why you get that super quick move, in maybe a couple weeks, is because there's shorts that were caught and they need to get out.
And this is a good question, because you mentioned to this me in the mock run-throughs. Is the bull snort kind of your favorite scan out of these different scans that you're going to talk about today? and you find it kind of leads to the majority of your winners, I guess?
Well, so I would say the majority of my winners come off me reviewing my lists. The
Right.
majority of my kind of quote unquote like more holds, come off me literally just looking through a couple 100,000 charts and finding the ones that I like. Um, but I would say the bull snort from a scan perspective is definitely my favorite scan. I think volume is by far the most important thing you can scan for, without a doubt. And I would say a lot of my kind of quick hitter swing trades come off the bull snort scan.
Perfect. I think we can move on to the next scan, but great questions, everybody, in the Q&A section. And if everybody could make sure to put their questions in the Q&A section rather than the chat, that helps keep everything organized and make my life easier and make Oliver's life easier as well. So thank you for all the awesome questions.
Okay, so next is gappers. So couple things here. Not all gaps fill. Definitely not. If you really read about technical analysis, you got breakaway gaps. You've got the gaps kind of in the middle of the move, and then you've got exhaustion gaps. So if you can find a gap out of a base, and there's volume, oftentimes those things are going to extend to the upside. So breakaway gaps can be a precursor to an extended move to the upside. This can overlap and often be a bull snort. And it can be for reasons like earnings, FDA approval, the pre-announcement. The key is right here, surprise. Anything that the market wasn't expecting or didn't know was coming, any type of surprise where somebody's caught, street caught off guard, Fidelity or T. Rowe Price is underpositioned in a growth name where the numbers came in way higher than they expected. Or maybe a short seller thought a company was, going to zero, and then all of a sudden they surprisingly turn a profit, and that short's like, oh my God, and they got to cover their shares quickly so the gap doesn't fill. Those are the types of situations you're looking for. So pretty simple. Again, price over 20 bucks, over 500K, and I'm looking for a gap up of 3%. Really, I like to see even bigger gaps. The bigger the gap, the better. I mean, you get like a 10% unfilled gap or 15% unfilled gap. That's great. I just do 3% because, I don't want to miss anything. And again, if I see just like a little gap, I'm going to use my discretion, maybe not pay attention to it. But sometimes when I'm doing my actual scans, just of, running through the stocks that I like, a little gap that goes unfilled on a name that maybe most people don't even notice, can be just a subtle clue. So that's something that I would kind of put in your back pocket when you're looking through your watch list, is just little gaps that go unfilled. I'm not saying run out and, market order the stock on the open or anything, but pay attention to that stuff, because there's a reason why that gap didn't fill. And it's because, the buyers were strong enough to keep it unfilled. So in addition to just this scan, it's something that I definitely incorporate to just when I'm reviewing my lists. So this was a trade I took last year. Actually took this twice. So SFIX gapped up, and I think I played this off the intraday chart the next day, and I caught this move, and I really thought this thing was going to just keep ripping higher. But it ended up coming in, and I sold it in here. I think probably down closer to the 10 EMA when it just didn't close well. And for me, that's kind of like a failed trade, like it's a winner, but whenever I see something like this, I think that, I caught on something huge, but when it doesn't work, I just get out of the way. But then is really where I did well on this trade is I caught this here. Kind of same deal here. It comes down under the EMAs. It builds what I call, this is not a bull flag, but I call it bull flaggish. I like these little just, descending type patterns. Maybe it looks like a descending channel on the hourly or something. And same deal. If you look down here, what do we have? We have massive volume or light volume, massive dry up is what I was going to say. and it's an inside bar. So you're going to notice that theme for me a lot: light volume, inside bar. And sure enough, we get the explosion out of it. And literally in like 2 weeks, this thing was up, like 80, 90%. And I actually thought this was going to go a lot higher. But once we lose this little trend, once the momentum's gone, I just kind of get out of the way. That's just my style. But this was just an example of something that you found on a gap up. And one thing I'll always say is they don't always go right away. Like in this instance, it looked like I wanted to go, but really the real trade set up a couple weeks later. So I recommend keeping a list of gappers, or you can put your bull snorts or gappers on the same list or something. And it can be something that you review each night as part of your routine. And maybe in here you're not paying attention to SX at all, and then you see this little bar and you're like, oh, that's interesting, but I'm usually not just going to buy on a bar like that. But then in here, you see the drop and you're like, okay, I'm going to put this on my watch list, or I'm going to set an alert up here, and you buy through here or something like that. But I think it's good to keep that gappers list and just review it every night, because sometimes these things may not set up for a month or two after they have that gap up. But then you can catch a nice rip in a couple weeks time.
There's a really good question, Oliver. I forget who asked it here, but do you care about the close of the gap up day, whether it closed strong or sold off into the end of the day? And also, do you care about the percentage of the gap, and also obviously the relative volume on that particular gap up day?
Yeah, so one, I want to see the big volume. So this was a bull snort as well, and that's often going to be the case. I do care about the close, in the sense that if this were to close like all the way down, like let's say it opened here and it traded down to here and closed on the low of the day, and the gap started out as a 40% gap, but then it's like an 8% gap by the close. To me, I'm going to say, oh, like the news was good, but it didn't really get supported. It kind of faded. So I'm still going to keep an eye on it, because sometimes those can kind of turn the next day. And then you're like, oh, okay, maybe they just took a day to step in. But something like this is fine. I mean, we gap up and we close a little bit lower than where we opened, but overall they supported it pretty well. And as far as buying it the next day or something, you kind of have to use your discretion. Often I would expect this to build out for 2 to 3 days. So there's no hard rule on that. You just kind of have to use your discretion as to when you play it. But yeah, you don't want them to gap up and then just fade all day long and close on the lows. Those are definitely situations where I would be a little bit more suspicious if it's going to work or not. And I wouldn't be looking the next day to play it long. Even if I saw it start to trade up, I would probably still rather wait and buy it higher, just because of how it traded on that first day.
Absolutely. And similar to the bull snort, do you care kind of how much overhead supply the stock has relative to this gap up? And do you also look to the left on the chart? Yeah.
Yeah, so I always prefer stocks that are trading at new highs. Always. Like that. Everything I do, I'd rather play something that has no resistance, for sure. But I do think you can catch a quick trade off the lows. Now, if something does have resistance to the left, I'm definitely treating that as more of a swing trade. Like I'm treating that as something where I want to be more aggressive and peeling my profits. Especially if it doesn't have things like big earnings, big sales. It's not like our prototype, top dog growth stock. Because again, some of those moves can just be squeezes, but they can also be some of the best ways to make a high percent return in a short amount of time. And this is not like, maybe I have my 8 cores, which are those vanilla names at new highs breaking out of bases, and I'm peppering in 1 to 2 swing trades like this, or not really like this, but like those triple D trades around it, that can kind of just add kind of alpha to what you're doing. And I don't take a ton of these each year. It's just the fact that if you can catch 3 to 5 of these, like literally in a whole year, and they move so quick in such a short amount of time that they can really help your account. So when you can find the ones that are going to work, and over time, as you get more experience, if you can focus on those ones, great. But a lot of these big gaps are going to be at new highs. I'll show you a couple examples that I'm looking at right now, kind of at the end of the session, that are all at new highs, like things like Peri, PERI, or ENPH. These are all names that are gapping out of bases at new highs. Those are the types of situations where you may be on like a real nice new growth stock that's just kind of being discovered.
Perfect. Yeah, I think that's all the questions I saw about gappers.
Okay, cool. So then strength, I think this is, fairly straightforward. Over $20, over 500, and literally I'm just looking for a stock that's positive. And I am not running this scan on a day the market's up 1%, because you're going to have thousands of names on it. I'm running it on the days the market's down. And the more the market's down, the more excited I get about running this scan. The market's down 1% and I can find a name up 2% with no news or no real reason why it should be. That is awesome, because it's a sign like, okay, there's no earnings, there's no news, there's no reason this should be up. Oh, it's up because institutions are buying this stock. And I want to pay attention to that. So again, specifically during market sell-offs, so you can uncover hidden gems during market sell-offs. Look for green names when the indexes are red. And that doesn't mean you run out and just buy the stock, but you see a stock that's consistently green when the markets are selling off, it's a really positive sign. And you can see this in Zoom during the COVID sell-off. We're selling off on the index. We're moving top left to bottom right, and Zoom is moving higher. And I mean, it doubled. Like it went from 80 to 160. And then in reality, once the market pulled out of the correction, it actually shook out because, people were buying other stocks and things. But then what happened? It literally went up, 300-400% from this point. So you could have missed 100% of the move. So again, a doubler. This thing doubled when the market was in a correction, and then it went on to rally another 300 or 400%. And you could have flagged this just by paying attention to what was moving up when the market was moving down. Market's moving down, it's showing up on this list, which it was. And sure enough, at some point, once you find an area to get on board, right here's a wedge pop, it moves higher. So definitely something to pay attention to on red days, and specifically when you get a string of red days in the market and you can find a name that's on this list for a couple of those days, the light bulb should really turn on and you're going to want to pay attention to that stock.
Perfect. And I think you've got an example here with Zoom, right? Which shows super relative strength during the correction.
Yeah. So just stocks that move higher during corrections often explode higher at the end of the correction. So what I showed on the previous screen was just this little piece right here. Market's correcting, it's moving higher. But then what happens, we move much higher once the market is ready to enter an uptrend. So the market rallied, I don't know, 50% or so last year. And Zoom, not even counting this double off the lows, Zoom went up, around 400%. So it went up about, 7 or 8 times the market. And you found this opportunity during the correction. Teladoc was another name. COVID sell-off, Teladoc was moving higher. And sure enough, it was, a big winner last year. And this happens all the time. I mean, if we looked at more small mid-cap names, I'm sure there were multiple names that did this during the COVID sell-off.
And there's a really good question here. Do you run the relative strength scan multiple times during the day when the market is down 1%, 2% to kind of see what's showing relative strength at different periods during the day?
So really is what I'm doing during the day is I'm going to go over my lists, but my key names list or my liquid institutional leaders list, I'm scanning those nonstop all day long, and I'm looking for relative strength on those lists. I'm sorting them by percent return. And then I'm also looking for something I'm going to show you in a little bit where, maybe on the intraday chart, I see the index is making new lows and whatever, I'm looking for stocks that aren't, which it's shorter time frame. It's very subtle, but that's how patterns are built, is stocks that, they rally up a little more when the index, has their morning rally or whatever. And then the index sells hard and it comes down, but it doesn't make a new low. I'm looking for situations like that all day long. But really on the names that I've kind of pulled out on my weekend work. But I think it's totally valid. I think you could definitely be running your relative strengths again like this during the day for sure.
Perfect. I think that's most of the questions I saw on the relative strength. But in general, I think you wanted to touch on this as well. What kind of market caps are you mainly focused on in terms of opportunities?
Sure. So I tend to probably trade more higher market cap stuff, because I like the way more liquid names move. I find that bigger institutions are playing in them more because there's more liquidity and they can put their positions on. So it's hard for me to put a hard market cap on it. Two of the names that I think are leaders of the market right now are NVIDIA and Tesla's $1 trillion company. So, I trade bigger caps, but I do think that a lot of really nice big winners, start out, somewhere in that, maybe $2 billion to $25 billion range. So I keep a wide range. Fastly was a name that I really did well in last year, Livongo, and they were certainly not $1 trillion companies. They were probably in that $5 to $10 billion range when they got moving. So, I always think about the market cap in context of what the company does. So if I'm looking at a $100 billion company and I don't really see a huge runway for it to get to, 500 billion, I'm going to take it with a grain of salt. Whereas like Tesla at $1 trillion, I personally think it could be 5 trillion. So, but that's just my discretion. I'm not a fundamental analyst or anything like that, but I use my imagination. Whereas a company with maybe a $2 to $5 billion market cap, if it's got a big enough theme, a big enough story, if I can really see tons of people using it, like Zoom, for example, was something that I just saw everybody in sales using, outside of COVID. And then it, got this COVID thing where everybody had to work from home. I mean, it was obvious. And to me, it wasn't out of the question to see this thing have, $100 billion market cap based on the fact that literally everybody who's in sales, and then also people who wanted to stay in touch with their grandparents or whatever, that was a whole nother additive piece to it. So I think about the market cap just kind of within context of where I think the company can go. I think a couple things that you want to look for in a growth stock, and I'll talk about this more in the top dogs, is, does this have potential to go viral from a consumer standpoint? Because I'd rather, 100 million people using my product a little bit at a time. I'd rather that than, some company where there's like, 10 enterprises that are going to use it and it's going to be a higher ticket item. Just because I think those more consumer pushed products, those are the ones that can really, really grow their revenue.
Perfect. I think that answers that question excellently. And there's a question here. I'm trying to find it. People notice that a common criteria for yours is over $20, which you talked a little bit about. It makes things more liquid, more than institutions, but also people are asking kind of how you incorporate fundamentals with these price and volume scans.
Yeah, so I'm going to go over how I think about fundamentals when we get to the top dog stock.
Perfect.
So I'll just kind of table that until we get there so that I'm not, double dipping. But I would also say a lot of the times I'm trading like $100, $1,000 stocks. It's just something to keep in mind. 20 is like the minimum. Pretty rare I'm trading a stock that trades at $20.
Great.
Okay, so I wanted to just really show how you can look for relative strength, with your eyes. I mean, you can run all these scans and stuff, and that's great, and I do it. But the key is to be able to really see it. And one of the main ways you can see relative strength is by judging lower highs and higher lows relative to the index. Another way is to be looking at, where a stock is set up on the moving averages. So let's say the indexes are correcting and, you've got some stocks pulling back to the 50-day. You got other stocks that are only pulling back to the 20-day. Your strongest stocks are only pulling back to the 10-day. That is a simple visual filter. The ones pulling back to the 10 and 20-day are stronger than the ones pulling back to the 50-day, right? So that's like a very easy way to see relative strength. Now, when you get into bigger corrections, something like a 15 to 20% sell-off, which those should be the corrections that get you really excited, because those are the corrections where you find just massive new winners that are new. They're new. No one's paying attention to them. This is the way that I'm really looking for relative strength right here. So this is just like the index on the left, or, some sort of underlying. And then this is a stock on the right. So we come down and that stock may come down and it moves back up with the index. So like these are literally replicas right now. But then the index comes down and it makes another lower low. That's C. And the stock that you're paying attention to makes a higher low. That's key. That's very, very key. And, you just as an observer, somebody trying to find opportunity, the light bulb should kind of go on. The index is making a lower low. The stock that I'm paying attention to is making a higher low. So the sellers were not able to push the stock down. Institutions came in and supported this at a higher price than at point B. And then is what you'll see is when the index eventually puts in a higher low, that stock has often built a pattern out. And when you buy it, it'll usually outperform. So I want to look for situations, and I do this off the intraday chart, the 15-minute or the hourly in names that I'm paying attention to every day, where as I see the index make a lower low, I'm looking for those stocks that make a higher low. I think it's one of the absolute best ways that you can really assess relative strength, because it is what it is. I mean, you can't, it is what it is. The stock literally made a higher low and the index made a lower low. It's a sign that, buyers are supporting that name. So I think it's something that you should keep in your toolbox. Probably one of the most important things you can do is look for situations like this. When we're in corrections, go study all big winners, in my opinion, and I bet you'll see this take place. I've done it actually, and I'd say 99% of the situations you see things like this happen. So any questions on that, Richard?
There are a few, but most people are just saying like this really helps put things in perspective. Some people are only looking at percent drop versus the index, but the higher lows kind of reshifted how they were looking at things.
So one thing I would say on that is that, so like most growth stocks are going to, even if a name is holding up, better than the index, there is potential that it percentage wise drops more than the index just because it's more volatile. But it may actually be showing relative strength. Like it may actually be building proper structure like this, but it's off a little bit more. So if you're strictly doing it on percentage and you're not analyzing the actual structure of the chart, you may miss some of the best opportunities. So just, something to take into account.
For sure. And we talked a lot last webinar about multiple timeframes. Are you doing a similar thing on an intraday chart when the indexes are declining and pulling back intraday to look for those divergences, the stocks that are holding up better on that particular day?
Absolutely. So I'm going to go over kind of how I build my lists. I have a list called the daily list, which is, the 30 or 40 stocks coming into the week that I think look, they look reasonable. And I'm looking for situations like that where maybe the index pulls back intraday. Maybe it's nothing. Maybe it's, pulling back, and, the stock on my daily list is building a little bull flag as the index sells off. Like that thing could rip out of that bull flag. And maybe it's something that wasn't on my focus list for the day that I take a trade in. And, I'm doing that all day long. I'm just flipping through my lists. It's hard. I often don't even take breaks during the day because I'm just like totally flipping through my list nonstop, looking for relative strength, looking for higher lows, looking for stocks that are, bucking the trend. I love it when the index sells off in the morning. I love it. I love gap downs, because I can kind of find that needle in the haystack that's holding up better than the market. And, sometimes you get involved in it and it moves up and it's just not quite ready yet. And you can take it off at, maybe a scratch or a small winner, but you were able to find that, opportunity to do that by just assessing relative strength intraday.
And some people are noticing that, and when you show Thinkorswim, you don't have a relative strength line, which kind of shows the trend of relative strength and shows this in a different way. But you've kind of trained your eyes to just look at the chart and be able to see that relative strength without needing that line. Is that right?
Yeah. So, I know people use the relative strength line from IBD. It's not something I pay attention to at all. Now that I bought MarketSmith, I'm going to try to start incorporating it more. But the one thing I can tell you is if you look at the IBD 50 and stuff, sometimes the RS line will be at 99. And when I look at the stock, I'm like, well, I wouldn't touch this thing with a 10-foot pole right here. So I think if you can learn to judge relative strength yourself, it's going to be much more helpful to you than the RS line. With that said, there are people that use the relative strength line strictly and have massive success with it. So it's certainly something that I'm going to be starting to potentially incorporate more, but I'm definitely not going to, buy a stock because the RS line is at a 99. I'm going to judge it for myself. And, and that's because that's what I've been doing for 10 years. And I would feel uncomfortable just buying a stock because the relative strength line is high.
Right. And back in my first interview with you at the beginning of this year, you mentioned also how you noticed Tesla hadn't broken the 200-day when the market had. Is kind of, if the market is below moving average and a stock is holding above that moving average, is that also another way that you kind of determine relative strength?
Yeah, absolutely. I think that seeing where a stock is, if the index is pulling into the 200-day and a stock's pulling into the 20-day,
right,
that stock's stronger. Or in that instance, the index was losing the 200-day, and in those more vicious corrections, those lower moving averages are going to be tested, and that can definitely be a way that you size up relative strength.
perfect.
And in like a normal, like let's say a normal, I hate to say normal because nothing is normal or not normal. But let's say like a 5 to 8%, correction in the index. The best names are going to pull back to the 20-day. And, you're certainly going to have opportunities where stock pulls back to the 50-day, like that Zoom example around 120. Stock built a little, tightening base structure around the 50-day. But, I want stocks that are holding like the 20-day in a normal correction, ideally. Now, in a more vicious sell-off, oftentimes the 20 days are going to be lost, just because the market was much weaker. However, if you can find a name holding the 20-day in a major sell-off, you may really be onto something nice.
Perfect. I think I don't see any more questions about specifically relative strength. So I think we can move on.
Yeah. And so one thing that one of my first mentors always used to say, corrections are great as long as you don't ride them down. So the thing with corrections is they have the ability to scare you and get your emotions high. But if you just look at the S&P, long term, we generally go higher. So I think the key is during corrections, rather than to get all bared up and short the heck out of the market, which, you can do that if you're good at that. But the key is to really find these needles in the haystack. Don't ride the correction down, go hunting, like look for that next big winner, because you're going to make a lot more money to the long side than you are to the short side. And oftentimes, getting all bared up is just going to cause you to miss out on some of the greatest opportunities, over the next 6 to 12 months. So let's go over an example here. Livongo, I say here, relative strength is a springboard for higher prices, and no doubt about it. So if we look at this Livongo chart right here, so we got the NASDAQ here on the left with the QQQ, and we got Livongo here on the right. So this stock really like fit the mold for what a nice big winner could be. It was after the lockup period, so I like to find IPOs post lockup period. I think that's kind of the sweet spot to really start paying attention to them. Sure, you can have names that move prior to that, but oftentimes they will wait. And then in the COVID sell-off, you can see at point A here, the NASDAQ made a new low. So we made a new low, and so did Livongo intraday, but it actually closed up. So at this point in time, that doesn't mean much to me. I mean, this chart is still pretty sloppy, and there's no tightening. There's nothing to do, but you can just kind of notice it, and it's good to know at this point. Then on March 12th, so point B, the NASDAQ makes another new low. And so does Livongo. But I think if you look at the low here in the NASDAQ, it's a little bit different than Livongo. Livongo, again, actually closes above that low, and definitely shows relative strength. So again, to me here, now at this point, I'm realizing there could be something here. This thing's really bucking the trend. NASDAQ, lower, lower, low, lower, high, lower, low. Livongo's almost like just trading flat. That's a pretty positive sign. Then at point C, NASDAQ again, lower high, another lower low. So we're making lower lows for sure. The index is definitely in a downtrend. And as you guys all know, I mean, this chart looks pretty orderly right now, but at the time, it didn't feel that way. I think most people would recognize stocks were just getting smoked left and right through here. So you're also taking into account a lot of the other names in your watch list are just getting crushed, and this thing's holding up. Now, we do have this shakeout here at point C, which, that's going to happen when stocks are building bases. So it makes a lower low. And, at this point, you may say, oh, maybe it meant nothing, because if it all of a sudden falls apart and just starts trending lower, then, it's just what you were analyzing here just wasn't correct, and that's fine. But what happens at point D, we scum a new low on the NASDAQ, we close higher, but Livongo clearly makes a significantly higher low again. So now again, your antenna should go back up. This thing is really building out, another higher low. Let's pay attention to it. Point E on the NASDAQ, we tick a lower low again, but again, we close higher. And that's a whole nother thing. Situations like this, maybe the selling is starting to dry up a little on the index, but the index, if we were to draw a line connecting the lows, that line's still moving lower. Whereas if we were to draw a line on the lows in Livongo, it's moving higher. So point E, we see our second higher low, which we never saw that over here. So we see a second higher low here. That should really, to you, be a sign there's something going on here. There's something going on here. NASDAQ moving lower. You can just draw a line showing it's lower. Livongo moving higher. And then when it tightens up in here, literally through this 24 area is a wedge pop. And it's really around when the market bottoms. If we look, the market actually bottomed in here, and this is around where Livongo had its wedge pop, but it tipped its hand and started showing this relative strength initially here, then it kind of shook out, but then, definitely again here, and then sure enough, we have this wedge pop, and you didn't even need to catch the wedge pop. I actually really sized up into this thing right here on the EMA crossback, right in here. But then sure enough, look what happens. This thing rallies 500%. It works up here. There really, some people, this was the traditional buy area for a lot of IBD folks, where this was like a cup with a handle. I know a lot of people played this. And then it rallies up, base and break, starts to get a little more sloppy in here. And then sure enough, it tops out on quote unquote good news, with the merger with Teladoc. So this stock was uncovered here during the correction. I mean, if you just step back and look at the NASDAQ sell-off after the fact versus Livongo really barely went down. So again, on a percentage basis, if we were to look at this, it looks like it had like a 35% correction, because if you were to take this high down to here, but it judge things with your eyes. I mean, this stock held in extremely well. And in retrospect, this is actually like a double bottom base, where we take out the lows, the wedge pop is coming back up through, and the buy area is, kind of right here, through this pivot high. If you want to go by the traditional IBD way of viewing things. So uncovered again via relative strength. And sure enough, these are the stocks that give you that massive upside move. So I guess hopefully we can get another big correction at some point. Hopefully not into year end, but maybe this coming February or something we can. That would be great, because then we can not ride the correction down. We can hunt for relative strength, and find some nice new winners to hit hard on the upside. Absolutely.
And we've got some questions here about, do you also look for price tightness during a correction? Is that a kind of sign, another way of determining relative strength?
Yeah, I mean, I'm looking for price tightness all the time.
Yeah.
All the time. So I think you always want to see tight price action. Tight price action is generally a precursor to a move. Tight price action is just a sign of a decline in volatility, which is, something we always want to see prior to a stock moving higher.
And there's another question here that was pretty good. Was Livongo making a 52-week high before the NASDAQ started selling off, or that history does not matter? And also, do you watch for 52-week highs during market corrections?
So you definitely want to watch for 52-week highs during corrections for sure. Because, if a stock's making highs and the index is making lows, that's a great sign. So for sure there. As far as did Livongo make a new high before the NASDAQ, I would have to look, but I would definitely, yeah, it had to have for sure. Because, I doubt the NASDAQ, we'll look when we get into the charting software, we'll look, but yeah, this definitely made a 52-week high before the NASDAQ. And as far as, I think the other question was, do you like stocks that make a 52-week high before the correction? It certainly doesn't hurt. So I can tell you that I actually bought this, I'm going to call it a breakout, but it didn't work. I actually bought Livongo here and got stopped out of it. I actually got stopped out here, luckily before the gap down, just because the market was just not right. But so this is a stock I was already watching. Because it was actually really showing strength in here. And, then it just kind of succumbed to the market weakness. And then when the market so this wanted to go higher, in my opinion, back here, but the market held it down. And then when the market was ready to at least stop going down, that's when it exploded.
And there was a question about why Livongo was on your radar. What scan picked it up? What list did you have it on?
So I'll talk about that. I keep an IPO list. So let me just table that until I get there.
Sounds good.
Yeah.
Perfect. Yeah, I think we can keep on going.
All right. So doublers, very simple. And actually, there's definitely a better scan you can run here, I think, which I'll talk about. I've just been using this for so long. Stocks that double are the ones that double again. Over $20, year-to-date performance plus 100%. That's really it. I've seen some people on Twitter use a scan where they just show. Actually, I got this from Eve Bobak. She looks at the bottom of the correction and the percentage off the stock's bottom, which I think could be a really good scan too. So I'm looking to kind of make something like that. I think either are both valid, but yeah, I like to see stocks. You get a month or so into the year. Sometimes actually this is a good one maybe to lower to like $15 or so, because maybe you get a stock that goes from 10 to 20, and stock doubled in the first month of the year or so. And then maybe it goes from 20 to 40, doubles again, and you don't get on it until later in the year when it goes from 50 to 100. That's fine. But the point is we're looking for stocks that double. It's not more complicated than that. So that's that scan.
And you mentioned that you start kind of looking at this scan kind of a few months into the year after that year-to-date performance. Give it time to double from the beginning of the year, basically.
Yeah, but that's also why I think that other scan where you're judging it versus the market low might be a better scan, because what's the first of the year? It's kind of just a date. But stocks didn't not trade in December 29th or 30th. So it's not the perfect scan. It's something I've used. I would say it's not where I get like the majority of my stocks, but again, these scans, you may run them every day and maybe get one stock a year off the scan. That's it. But that one stock can make a big difference for you.
And there's people asking whether you look for a 100% gain within a certain amount of time, like a high tide flag setup.
No, but again, if I see something on here and I see it make an advance in a quick amount of time with my eyes, then I'll certainly judge that differently than something that maybe ground out 100% gain over like 6 months. So all these scans I'm filtering with my eyes by looking at the charts.
Perfect. And people are asking for doublers, how do you decide if it's early or late within the trend?
With my eyes, just looking at the weekly, looking at the monthly, kind of seeing where it is. There's no filter for the well-trained eye.
Yeah.
It's more important than all these scans.
Yeah, and we discussed in the first webinar like multiple extensions on the weekly, that type of thing. So yeah, 100%. If you're confused about that, go ahead and rewatch webinar 1, which is archived in the course. So I think that's all the questions on this. Yeah, I think that's all the questions I see.
Okay. So 52-week highs, I don't feel like I need to go too in depth here. I mean, I'm just looking at what stocks are making 52-week highs. Kind of already went over why. Get a feel for what sectors are moving. You can add these to a list and filter those lists with your eyes. Sometimes a stock will make a 52-week high, but it's extended. It's not buyable. But then 2 to 3 months later, it builds a base. And if you've got it on a 52-week highs list that you've kind of built over time, you can go through that at night and find an opportunity. Then I'm going to go through my lists. And to me, this is really where I find my opportunities, because like I said, I don't think there's any replacement for the well-trained eye. I'm sure there are people who run scans and like literally get all their ideas off the scan. I build lists from my scans, and when I go through those lists, that's where I find my opportunities. So what are some of the lists that I build? So I have something I call the IPO list, and I literally just pay attention to the names that IPO. I'll give you a website later that I use, and I use my discretion to pull names out of that, and I just add them to this IPO list. And it's got hundreds of names on it at this point. I probably need to go in and clean it up, because a lot of IPOs tank and they're still on this list. But I just build a list of IPOs. I think you could run a scan, and a good scan would be, there's a guy that I follow on Twitter who I absolutely love his list. This guy, John Stares at Candles. who he'll put out lists of companies that IPO'd within, the last 2 to 3 years, that are trading near their highs or something like that. And I'll take those lists and I'll look at all those names. I'll add those names to my IPO list, because I often find that some of the big winners break out or start their advance, in that 6 to 18 month age range. Sure, could it be 2 years or so? Sure. And that's fine. But I think that's kind of the sweet spot post lockup. But not too long. Like at Facebook, I think was about 13 months or something like that. Those are kind of the sweet spots. And if you think about some of the winners or popular names people are on now, like an Affirm certainly fits that mold. If you had it on your IPO list, then all of a sudden it has that massive gap up or that bull snort. And, that's kind of what led to the move starting. So keeping an IPO list, I review this every single night, I think is a great list and, an area to kind of farm for winners. Bull snorts, as you guys kind of know, I love volume, and a lot of the time the gappers are bull snorts. So I'll just throw them on this list. And I look at it each night. I have what I call an institutional leaders list. Again, this is kind of built at my discretion, but this is where a lot of the names that I trade live. So it's got, names like Apple, Microsoft, Netflix. It's got some of the high flyers from last year, Square, Peloton, Roku, which I'm probably going to start removing some of those names from the list because I just think they're never coming back. But it's just liquid names that have done well, names I'm trading now, like, Asan, Amba, Dokken, they'll go on this list. But it's just a list that I build at my own discretion. They're liquid, they're quality names that I know institutions are looking at. I would say this list is anywhere from, 60 to 100 stocks. And you do need to go in and clean it up, every, maybe once a year, go in and clean it up and just, for example, if Roku misses earnings and trades down, I'm going to take it off the list. I just took Twilio off the list this past week. So that's a list that I value a lot. Then my daily list is a list that I build going into each week. And a lot of the times the names are the same as the previous week. But it's really, if I go through and I look at monthlies or I review the Growth Stock 250, or I just do all my work that I'm doing day in and day out, it's like the list of 30 to 40 names that I think, show potential or I want to keep an eye on. Maybe they're not all set up, but for whatever reason, I think they're building out. For example, names that I don't think are set up right now, but like Roblox, for example, I think has the potential to be a big winner eventually. It's got a lot of work to do, but if it ever gets it together, it'll be a stage 1 IPO base. So like that's on my daily list. I'm keeping an eye on it every day. I'm watching how it trades. I'm studying the price action. I like to know my names and be familiar with how they move. And by having a daily list of, 30 to 40, quote unquote, good names, I can start to get to know their character, well before I'm ever even trading them. Then next would be the focus list. So coming into every day, I have the ideas that I may trade. Like it's that simple. If I think something's actionable, if I like the chart pattern, if I think that there's a actionable trigger, some days this may have no names on it. Some days it has 2 or 3. Some days it has 3 to 5. I'm usually not putting too much more than that on there because, it's tough to, buy 12 names in a day. So I want to keep it small. And then maybe if there's like 1 or 2 stocks that I don't think are quite ready, but that I'm really just like, I want to make an emphasis to keep an eye on the name, I may put it on the focus list, just knowing I'm not going to trade it. But, I just, for whatever reason, I really want to keep an eye on it. Then lastly, I have a list called the top dogs list. And this is my most important list, I think. It is a maximum of 10 names. I sometimes stretch it to 12, but I really, my goal is to make it 10, because I want to try to decipher what I believe at that current point in time to be the absolute best names in the market. And I want to force myself to keep the list small, to keep it to 10 or 12 names. Because in reality, when I start getting over 12 names in my account, it's usually a sign. And it's funny, Richard and I were talking, and last week I told him I had more names than I wanted, and sure enough, we got that shakeout day. Usually when I get more than 12 names, I'm about to have a bad day. I'm trading my best when I have, 6 to 10 names in my account, and I'm I have bigger positions. I'd rather have bigger positions in the top dogs than own like 20 names. So by having the top dogs list, it's not necessarily, it doesn't mean that they have a buy area. Maybe it's a name that I missed, but I still think it's a top dog. And I want to be really, really focused on those names so that when they do set up, I don't miss them. Like, it's key. I want to be on the top names in the market, no questions asked. Then lastly, and again, this is something that I'm learning. So there's definitely better people to learn about MarketSmith from. I think Richard's done some great videos on how to use MarketSmith, and I try to watch those. But reports, stocks, technical, if you follow those steps in MarketSmith, there's some pretty cool little filters, top 150 earners, top 150 relative strength. I like the accumulation distribution rating because it's literally just kind of showing, what people are buying. I think the most important list I would care about would be something to scan for revenue growth. I think it's the most important thing to look for. And I'll kind of talk about that. But I wanted to break down more what a top dog is, because this is what's really, really important to me. And these are the names that I really like to zone in on. So a top dog, what's best in breed, right? We want to trade, purebreds, not mutts. I love mutts. I love all dogs, but just as a point of emphasis. So one, we want relative strength. Like, a top dog is not going to be a stock that's underperforming the market. Your stock should be outperforming the market for sure and be showing relative strength. That may even be, the most important element, because who wants to trade a stock that, has big earnings and big sales that's underperforming? I don't. Big early stage base. So if you haven't read How to Make Money in Stocks, read How to Make Money in Stocks, and kind of learn about the different stage bases. So I am not one of those people who thinks that a stock, can't still be a big winner after it's stage 3 or stage 4 base. I mean, you go say like, hey, I don't buy anything after a stage 3 base. Okay, well, Shopify's had like 9 bases. Like, you would have missed the last, 1,000% or whatever. However, once a stock has had like a stage 3 or stage 4 base without like really having that 20 to 30% market correction that truly resets everything, I am, a little more careful in how I'm analyzing that stock. So like a top dog, I want to be an earlier stage stock, often an IPO breaking out of a stage 1 base in that 6 to 18 month range. And the reason being is because it's undiscovered at that point in time, which means institutions, if they put in good numbers and the thing is, delivering on what they say they're going to deliver on, institutions need to buy the stock. Whereas something that's, stage 3 or stage 4, a lot of institutions already own the stock. And the most important thing about buying and selling stocks is, stocks go up when there's more buyers than sellers, and they go down when there's more sellers than buyers. Therefore, stocks top out when there's nobody left to buy, and they bottom when there's nobody left to sell. So if you're trading like a stage 3 or 4 base or something like that, and everybody's already bought it, it doesn't really matter how good the earnings are, how good the sales are. If there's nobody left to buy it, it's not going to go higher. So I like to focus on those early stage situations. Then 3, big volume. again, I don't know how people say volume doesn't matter. I don't think you're ever going to find a stock that really advanced multiple hundreds of percents that didn't have positive volume signatures in its base. Big theme, this is maybe the secret sauce, kind of the art of finding winners is how you analyze and think about the theme. So a couple of questions I like to try to ask myself when I'm thinking about a company, is this disruptive? Does it make sense? Is it complicated or simple? Because again, I think the best growth winners are the ones where consumers take the company viral, like millions, hundreds of millions, hopefully, of people start using that product. And most people like simple things. So therefore, like the concept or the theme behind what you're trading, should make sense to you and you should be able to understand it. Sure, these crazy, insanely complicated, techie galore type situations happen and they work big. I don't think the average person's going to know what Cloudflare does. It's still a big winner. You're going to have exceptions like that. But then you're going to have the Dutch brothers, where it's like a coffee shop and, you're seeing them pop up on the West Coast and it could grow. That's something simple that you can understand, right? Or Zoom. Hey, everybody's literally using this product. Peloton, like everybody's like girlfriend or wife was on Peloton and loved it. It's right there. It's right there. It's the Peter Lynch, buy what you know, something easily understood. So from a straight up fundamental standpoint, definitely looking at earning and sales growth. But I think by far, without question, the number one fundamental criteria for me is sales or revenue growth. And the reason being is companies that can generate enormous sales or revenue growth, they're selling, they're growing, they're taking market share. And go look at some of these names, like Amazon, technically had no earnings for like 10 years and it went higher because they were reinvesting all their growth back into scaling and growing the company more. And then eventually, they were able to, scale that back a little bit and start to generate positive earnings. So I don't think every company needs, positive earnings, but I think they need massive revenue growth and then a runway to have positive earnings. We don't just want to be trading companies that, they grow quickly, but you're looking at it and you're like, this thing is like never gonna have positive earnings. So sales growth is hugely important. I know two names that I traded last year that had huge revenue growth. Zoom had massive triple-digit revenue growth. Zillow had massive triple-digit revenue growth. And they were both big winners. I think if you read the O'Neill Disciples book, he talks about how, I think, I haven't read the book in a little, but he talks around, around the internet bubble, they really started noticing this theme, and that more online internet type companies would have huge advances based on massive revenue growth, even when they didn't show, the earnings growth you typically would look for. But then, down the line, often like when they topped out, they started showing earnings growth. But with that said, earnings growth is key. I mean, if you can find a stock that has big sales and big earnings, that's ideal. The one thing that I would say, and I learned this when I traded institutional sales from a fund manager, you want to avoid situations, and sometimes you'll see this in cyclicals specifically, where like the earnings jumps a lot, but the revenue growth doesn't confirm it. And the reason being is there's ways that you can kind of game your earnings. You can lay people off. You can cut costs. And I think that's one of the reasons why William O'Neill looked for earnings growth for 3 straight quarters, is because it's tough to do that for like 3 straight quarters. But that's one thing I would say is, maybe a bull snort off the lows on a big earnings report can lead to like a 2 to 3 week advance. But if it's just like that one-time bump to earnings, and you're not seeing the sales growth accompany it, it's probably not going to be something that extends into a huge winner. Okay, then
Can I jump in, actually?
yeah.
Yeah, people are curious about whether you have kind of a baseline number for revenue growth, sales growth. Is there like a minimum growth quarter over quarter or year over year that you look for in general?
I don't. I like to see at least 40%, but really the higher the better. I mean, if you can get triple digit revenue growth, that's key. That Zillow and Zoom both had triple digit revenue growth last year, but I think at least 40%. I think when I do have a fundamental scan, which I'll show you guys on FinViz. I think I set it at 20% just because I don't want to miss anything. But the higher the better, and I think 40% is a pretty good threshold to try to be above.
Yeah, and going back to Livongo, I think it had 100% sales growth, revenue growth the 4 quarters before it broke out and went on the huge run in 2020. So yeah, the higher the better, in my opinion, as well.
Yeah, triple digits is really what you want.
Perfect.
Okay, then this next one is, in a way, it's discretionary. I know you can filter for beta and stuff. I definitely don't. But you want high beta and liquid. So I want names that move more than the indexes. And then I also want them to be liquid. And when I say liquid, I'm not saying, hey, the dollar volume of this stock is X, I can get in and out of it with ease. I'm more actually like literally looking at the character of the stock. If I go into a 5-minute chart and I see a stock that, trades down 2% on a downtick, it can trade as much volume as you want. It's probably not a stock that I'm interested in trading, just because I don't think it moves uniform. So it's hard for me to describe this, but I want stocks that move in a uniform manner, because I think the patterns are more predictable. And I'm a pattern trader, so I don't like trading stocks that rip up 10% and then the next day they're down 10%. I'd rather the stock that's up 5%, 3%, 1% pullback, up 2%, just because they're easier to hold. And I'm an emotional person just like anybody else, so I try to help myself out a little bit there. And then I do say here, find balance. And is what I mean by that is low float stocks do put in the fastest moves. Now they do it in both directions. So I'm not saying, not to trade low float stocks, but I want to try to find that low float stock that just moves more uniformly. I wish I had a better way to describe it. I think it's something that you can pick up on by literally going through and looking at thousands of stocks. I can scroll through and see a stock that looks decent, but it's got huge wicks up and down and all over the place. And I'm just flipping through that one. And it could be a great stock, but I'm unlikely to make any money in it. If you really, really love it, or if I really, really love, maybe buy a little on a long-term account or something. But from a trading perspective, I've just kind of figured this out over the years that those aren't the types of stocks I do well in. So no matter how much I love it, I typically just don't trade them. And then higher price, I wrote above $10 to $15 at a minimum for me, but really a lot of the stocks I trade are over $50, even over $100. I think that's because you can risk much less on a percentage basis. For example, Tesla's $1,000 stock. You can buy that with a 7 or 8 point stop and you're risking 70 to 80 bips, but it still has the potential to double. So I like to kind of manage that downside, and I think it's easier with those higher price stocks to do that. And I will say here, nothing against penny stocks. I mean, they clearly work huge. I see people who are up 10,000% on a year trading penny stocks and stuff. So there's a bunch of ways to skin the cat. Just for me, I find that they can be higher risk and they have less institutional sponsorship. And, if you can do 10% a month and compound that throughout the year, you can make a boatload of cash. So I'm looking for those more, you know, higher price names where I think you could trade Google and Microsoft and do 10% a month and do really, really well. But it's also a lot easier to manage the downside on those. So it's just what works best for you, but that's what works best for me. So any questions kind of on this criteria? Because of all this, like I think finding the top dogs, this is the most important, and this is really, really where I'm trying to focus my money.
There were questions, a little bit of confusion, I think, about the high beta and liquid. Can you talk a little bit more about why you focus so much on those type of names?
Sure. So, we want names that move faster than the market. Because if we're going to sit here all day and we're going to own, 5 to 10 stocks, like we might as well own names that can really rip for us. So I don't want to trade Procter and Gamble or, Pfizer. They just don't move enough. Like they just, for me now, some people, that may be their personality. And I go back and forth on this too, where, healthcare is in favor, oil stocks are in favor, financials are in favor. And, a lot of the names in those sectors don't move as much. Should I move off of the growth type names I want and trade those? And I think you can, but the thing is you risk missing that Livongo or that name that's going to go up 400 or 500% because we're just trying to buy what was moving up. And I don't know. It's like a tough thing to say. I just think one, high beta, you want names that move more than the market because oftentimes a good growth stock or all the time is going to move more than the market. And then, from a liquidity standpoint, it's more, can I get in and out of the stock without a massive amount of slippage? And am I going to get these ridiculous shakeouts that if a stock trades 100,000 shares a day, an institution can move that stock down like 10% just because there's not a lot of liquidity, and maybe they move it down so that they can buy a bunch more shares. And I want names that, one guy can't move around. If maybe that's a way to kind of critique it, I want names that, no one person can just like blow the market out one way or the other, because I just think that the price action in those types of stocks is more predictable.
For sure. And going back to the big theme part of this, there's a lot of questions about whether you look for group themes, whether you look for stocks in overall strong groups and in leading sectors in MarketSmith as they define it. So if you talk about how you look for these big themes that you see and also whether you consider the overall strength of the industry group the stock is in.
Sure. So I'm definitely a bottom up trader. And I think that looking at industry groups, and I see people, saying, hey, this industry group went from 70 to 6 or whatever. I think that's all valid. I don't really spend any time doing that though. Because a lot of the times, maybe I can find the best stock in a group when the group's at 70. And by the time the group's at 6, that stock's rallied 100%. So I am more focused on individual stocks. With that said, I'm looking for like overall themes. So like, I think, an overall theme here is, we're seeing disruption in the financial sector. We've got the buy now, pay later type thing with the Firma. I think Sophie is a stock that potentially could be a big winner. I think it totally disrupts what some of the big banks are doing. So, if I can find a couple names that kind of fit into that theme, I'm definitely paying attention to it. So, that's something. But for example, like Dutch Brothers Coffee has been like an IPO that's done really well. And, I know food stocks as a group, I'm guessing, because I actually don't know, but I'm sure that group has done better. But you're not like buying that stock because you think like food stocks are doing well. you're buying that stock because it's a, more local type brand, and you think it's going to go national, and you think it's going to explode. You think it's going to be like the next Chipotle, or, the next Starbucks, or something along those lines. And for me, I'm looking at that, I'm thinking about the theme, then I'm looking at the market cap, and I'm saying, oh, okay, this thing could really, really grow. So I'm looking at that specific stock, not the industry group. But I think it's totally valid to look at the industry group. It's certainly better to trade names that are in better industry groups. But I'm looking for those more needle in the haystack type stocks. And, sometimes you might miss them if you're strictly focused on the industry group. And one thing I'll say that's not on here, but I think like a top dog, it may pay zero attention to the market. like go back and look at Tesla last year. There were moments where the market was going higher, and like you could say Tesla was showing relative weakness, but it was really just doing something totally on its own. And I think that can actually be a sign, especially when one of these IPOs is in its stage one base, that you should pay attention to it. Where like the market's selling off and the stock's showing relative strength, or the market's going up and the stock's like looks like it's showing weakness, but it's really just like trading entirely on its own. Like I almost think that that's a sign, like, hey, this stock has a mind of its own. And then when those things do kind of, turn on the engines and start moving up, those are the names that can just move up like literally every day almost. So that's like another little subtle thing. I don't think there's any way to like scan for that or anything. It's more of a feel type thing. But that's something that, subconsciously, I guess I kind of notice.
Perfect. I think we can move on. I don't see too many questions about this slide.
Okay. But guys, I can't emphasize enough, like, this is like really what I try to do is find these top dogs and find a way to get on them. Just stay with them, stalk them, stay focused on them. That's really my style. Okay. So weekend routine. And again, like you gotta love the routine. This is stuff that you gotta do. So I don't do this every weekend anymore, but when I was learning, I definitely did this, and I highly, highly, highly recommend going through some sort of A to Z or big list of stocks, because without you even noticing it, you're going to pick up and learn how stocks move by looking at thousands of charts. I definitely do this at least once a quarter. I would say I probably should do it every weekend. But just with a kid and stuff, and it's hard to find time to do that. But for me on Thinkorswim, I review the Russell 3000. They used to have the Wilshire 5000, but it's just not there anymore. But basically find whatever list works for you that has thousands of stocks on it and go through it. And I would say go through it looking at the weeklies or the monthlies. Find good monthlies, write them down, and then go through those monthlies on a lower time frame, and just filter it down until you can kind of build your daily list of 30 to 40 names. My mentor literally does this every weekend, and if he doesn't do it, he feels totally off on Monday. And I'm not even saying that he's buying all the names that he finds in here. It just gives you a great feel for the overall market, just in general. If the market's in a correction, but lots of names look healthy, maybe just a little ahead of themselves, you'll pick that up when you go do a review like this. Often when we go in a correction is when I definitely start doing this. Then I always look at my liquid institutional leaders list. Some of them I view as kind of beat up and of no interest or whatever. But some of them are the names. Right now I think the 5 liquid leaders of the market are Tesla, Nvidia, Google, Microsoft, and Netflix. Am I trading all of those? No. Do I own some of them? Yeah. But overall, I'm looking at this list. This is often where I find some of my winners because I've traded them before and they've worked for me before. And then maybe they just needed to consolidate or rest. Once they set up again, I'll pick up on them on here. Then I do, this is the main thing I actually, well, it's probably the second main thing, but with MarketSmith, I love their cell phone app. Um, in the car, I guess I don't have in the car, I'll keep one of these Amazon Basics notepads or something, and I'll flip through the Growth 250 on the cell phone app and just kind of write interesting things down. I think it's a good list. It's got, like 250 stocks. It's kind of filtered, by some of the IBD characteristics like earnings, sales growth. And then I think typically the names are the stronger names. I'm not 100% sure what goes into the filter, but good names are on there, and it's a good list to just kind of do. I do it on the phone app. But really, Saturday morning, I'm kind of trying to have my list of 30 to 40 good looking names for that daily list. A lot of the time, maybe 75% of the names are the same as the week before. But Saturday morning, like literally right now is kind of when I'm doing this, usually even a little earlier. My kid goes down from like 8:30 to 9:30. That's kind of a good time for me to do this stuff. And then Sunday night for me, it's almost like any other weeknight, because it's the night before Monday, which is a trading day. But I am really like grilling the top dogs list to make sure that I'm focused on the right things, and I'm trying to make sure that that's up to date. And I'm kind of almost trying to challenge the list a little bit for myself. Like, hey, this is a good name. Is it really a top dog? I think X name is better or something like that. And I will actually write out on a 8.5 by 11 piece of binder paper. I'll kind of go through the top dogs and write out, what I like about it. And then maybe below it, I put a couple other names that I'm keeping an eye on. And the reason I do that is I'll just kind of reference it during the week. All that stuff's in my trading software in the lists, but it's just something that sort of worked for me. And actually, I just throw that out at the end of the week. But I'm sort of thinking that I should maybe have a binder where I just kind of keep those so I can go back and review them. But that's something that I do. I kind of do my final run through for the daily list, just make sure my 30 to 40 are good. And then I create my focus list, the names that I'm interested in. I'm ready to go. And then I've definitely got my plan set for all my open positions. I really think about my open positions over the weekend, and then I kind of make tweaks to the plan during the week. So that's kind of my weekend routine.
And how long does this usually take you?
So again, I'm not doing this as much anymore. Where again, if you're starting out, you should be doing this every weekend, like no doubt about it. It's such an important exercise. But this probably takes me about an hour. Like I'm usually doing this part, the Growth 250 in the car. Just whenever we're driving somewhere or something like that. But I'm taking that notepad, and when I'm going through this, I type those names up in my actual trading software, because I feel like I get a different look for them in my trading software versus how I see them in MarketSmith. So this takes me about an hour. It might take you longer. I've been, doing this for a while, and you just get faster and faster at it. So it doesn't take me too long. This is almost kind of like my review, where I know that there's no, like, I'm not trading it tomorrow, so I can be a little more relaxed in how I go about it. Whereas this is more my, okay, like, let's go. We're getting ready for the week. Like, what are we going to do? We got what we want tomorrow. We're ready on our open positions. And this probably takes me, another hour. My wife's on here, and I know she's probably cracking up, because she'll say, oh, how long do you need? I'll say an hour. And, 3 hours later, I'm still looking at charts. So, take it with a grain of salt. I probably spend a lot more time than an hour, just because I love this stuff.
And there's a really good question that a few people asked. What time frames are you looking at when you go through these charts? And what do you mean by a good monthly?
So usually when I'm going through this list, I'm definitely looking at the weekly or monthly. And a lot of what I'm doing on Saturday morning is looking like the liquid institutional leaders list. I'm mostly looking at the weeklies here. And that's because I'm trying more and more to make sure that I don't lose sight of what's happening on the weekly and the monthly. I make a lot of mistakes where I overtrade on lower time frames when, like, literally nothing's happening on the weekly chart. And one of my goals is to trade less. And so I'm trying, and I think I definitely incorporate the weekly and monthly probably more than like a lot of people. Um, but yeah, Saturdays look at the weekly, monthly. Sundays I'm more looking at like the weekly, daily, and then maybe even something like the focus list. I might even be zooming into the hourly to just kind of see how things are set up on the hourly chart. Yeah.
And there's several people who have asked the question about if they work full time, how should they prepare if they've got limited time? Like you obviously just had a kid, so how has your routine kind of changed, and how would you adapt it to focus on the best of the best opportunities if you have only a few hours on the weekend to go through and look for those opportunities?
Yeah, so I think, if you're starting out trading, it's going to take you some time to just like build up these types of lists. So like, this is what I do. So and I've been doing it a while. So I already have these lists created. And I think if you have those lists created, you can go through your IPO list. And actually, I should say, I'm definitely going through my IPO list here Saturday morning. Sorry, that's not on there. Like, that's definitely something I'm doing. Really, all my main lists I'm kind of going through here. But I think like going through an IPO list and then just kind of like a liquid leader list is really all you need to do. And then kind of once you have established the top dogs, really, really staying focused there. So I think you can definitely trade while you're working full time. I almost even think it can actually be a huge positive because you're not watching the market too close. And the nice thing is too, is there's some great cell phone apps out there, like the Thinkorswim app is amazing. And the nice thing is too, you can be more focused, right? You can't look at everything because you just don't have the bandwidth to do it, which again, I think can be a huge positive. By working full time, I think the key is to stay focused on the top dogs and be concentrated in those top 3 to 10 names. And when I'm watching the market every day, if I'm working full time, I'm focused on what I have to do that day, my top 2 to 3 names, and then the positions I own, and I wouldn't be looking at anything else. And I think you might even be able to trade better if you're working full time. So view it as a positive. Think about Darvis. He was halfway across the world and debatably did better than most, if not anyone else, trading the market when he was. He didn't even see the quotes for a couple of days. So don't use it as an excuse if you trade full time. Just find a process that works for you. Stay focused. Don't look at too many things. But I do think learning, doing an activity like this, or I think a great thing that my mentors had me do is go look at, like the top 100 winners from, the last year and the year before, and go through them on weekly charts and study like how many times did the stock lose the previous week's low and things like that. And I think it'll be eye-opening to you if you do those types of things, because stocks that are being accumulated usually don't lose the previous week's low, until they get extended, and then it's natural for that to happen. But doing types of things like this and studies like that when you're learning, it's going to kind of help you train your eye as to what to look for. And that type of work is irreplaceable. I think it's unrealistic to think you're going to come in and just like make money consistently after a year or two of studying. And doing things like this are going to help you increase that learning curve because you're going to look at thousands of charts.
Well said. And you kind of sum it up. You have to love the routine, right? You have to put in the work.
Yeah, like literally my mentor's been trading for like 17 years. And if he shows up on Monday morning and hasn't done all his scanning, he'll tell you like, oh, I feel so out of touch. And I mean, this is a guy who can trade. So, even someone like that, just goes to show you that you have to find, and I don't have the same routine as him. Like I don't have that same routine. So I think find a routine that works for you is the key. But this is, these are just some ideas of some of the different things that I do. And if you can take some of it and do it, great. And, maybe you say that's ridiculous to look at the Russell 3000. that's fine too. Find what works for you.
Exactly, and we actually have included in the workbook kind of their homework assignment today is to fill out their daily and weekly routine, and hopefully you've kind of incorporated some of what Oliver is talking about in this presentation into that. But find exactly what Oliver said. Find what works for you. Not everybody's process is going to be the same. Nobody has